Yo, what up? This is KMT the Ra, and welcome back to another KMT Productions video. So before we get started, I'm just gonna have to ask that you guys go ahead and like the video. It really helps out with the YouTube algorithm, and if I want to get some more visibility on these videos, I need your guys' help, so like that video. Also, if you haven't already, go ahead and hit that subscribe button. I'm trying to build up a community of people of like-minded individuals who want to, excel and grow and then share information amongst each other. So go ahead and subscribe if you haven't already. And also, if you guys have any suggestions for any topics you may want me to talk about here in the future, then leave that in the comments down below as well. So without further ado, let's go ahead and get started. The topic for today is assets and liabilities. So let's start at the top. Assets are what a business owns, and liabilities are what a business owes. Both of these are listed on a company's balance sheet, which is a financial statement that shows a company's financial health. So assets minus liabilities equals equity, or an owner's net worth. A company's assets should be more than its liabilities. In accounting, assets, liabilities, and equity make up the three major categories on a company's balance sheet. One of the most important financial statements for a small business. Assets and liabilities form a picture of a small business's financial standing. Assets are everything that a business owes. They're found on the left side of a balance sheet. So there are two types of assets. There are current and fixed assets. Current assets are assets that can be quickly converted into cash, also known as liquid. They include cash, accounts receivable, and inventory. The more current assets a small business has, the better, as this means that they can survive longer without having to borrow money. Fixed assets are physical items that can last over a year and have financial value to the company, such as computer equipment or tools. Tangible assets are physical objects that can be touched, like vehicles. Intangible assets are resources that have no physical presence, though they still have financial value. A couple of examples of this would be like copyright or brand recognition. Liabilities are everything that a business owes now and in the future, so they're found on the right side of the balance sheet. A common small business liability is money owed to suppliers. That's called accounts payable. All businesses have liabilities unless they exclusively accept and pay with cash. Cash includes either physical cash or payments made through a business bank account. There are two types of liabilities. There are current and long-term liabilities. Current liabilities need to be paid back within a year and include lines, loans, salaries, and accounts payable. Most company expenses are current liabilities. Long-term liabilities can be paid back after a year, and they include things like mortgages and bonds. A business's balance sheet helps an owner discover what their company is worth and determine the financial strength of their business. The accounting formula, also known as the basic accounting equation, is a way to calculate net worth. To find this amount, you use the following formula. Equity should be positive, and the higher the number, the better. A negative number means that the business is in trouble and action needs to be taken to minimize liabilities and increase assets. The balance sheet should also be reviewed periodically to make sure that the business's liabilities are not growing faster than its assets. So what is the difference between assets and liabilities? In accounting, assets are what a company owes, while liabilities are what a company owns. In other words, assets are items that can benefit a company economically, such as inventory, buildings, equipment, and cash. They help a business manufacture goods or provide services now and in the future. Liabilities are a company's obligations, either money owed or services not yet performed. A company needs to have more assets than liabilities, so that it has enough cash or items that can be easily converted into cash to pay debts. If a small business has more liabilities than assets, it won't be able to fulfill its debts and is considered in financial trouble. Still, liabilities aren't necessarily bad, as they can help finance growth. For example, a line of credit is taken out to purchase new tools for a small business. These tools will help a company operate and grow, which is a good thing. The trick is to make sure that the liabilities don't grow faster than the assets. So I'm going to go over a short list of things that could be considered assets. So we have cash, accounts receivable, office furniture, office equipment, fixtures, deferred discounts, cell phones, computer hardware, computer software, tools, machinery, equipment, boats, vehicles, buildings, lease agreements, cost to improve a lease space, land, modular office buildings, customer parking or garages, warehouses, inventory, really any investment that matures in less than 90 days like stocks, U.S. Treasuries, bonds, mutual funds, market funds, prepaid insurance, intellectual property, brand equity or recognition, company reputation, copyrights. So here's a list of liabilities that you may be able to expect when you're running a business. So there's accounts payable, which is, money owed to suppliers, and that includes payroll and rent. Unearned revenue, customer credit, credit cards, taxes on investments, wages owed, salaries that are owed, sales tax that is owed, interest payable, income tax payable, lawsuits payable, customer deposits or prepayments for goods and services, debts, lease agreements, insurance payable, benefits payable, contracts, accrued liabilities such as things that you've been lent. For small business owners to understand a company's financial standing, they need to be aware of what qualifies as an asset and what qualifies as a liability. So I have a few examples of a few businesses and what to expect in terms of assets and liabilities, right? So for example, a freelance copywriter may have assets such as a laptop, a printer, cash in their business bank account, payments pending from 2 or more clients. Some liabilities might include an outstanding balance on their business credit card from buying said laptop, an unpaid cell or internet bill, sales tax that they've collected but they haven't remitted to the state yet. A hot sauce maker would probably have assets such as desktop computers, hot sauce inventory, machinery and equipment used to make the sauce, including containers and cooking gear. An unpaid invoice from a local grocery store chain that sells the sauce, the building purchased and used to house the business. Some liabilities might be payroll not paid to the staff yet, payroll for sales tax that you haven't sent to the government yet, a bill for ingredients that hasn't been paid, a line of credit that was taken out to buy equipment, mortgage or a mortgage on the building. If you had a house painting business, some assets that you would have would be like a company van, painting equipment, painting contracts that you already have in place, savings in the bank, a computer, and a printer, right? And then the liabilities for painting companies such as that would probably be business and liability insurance that is owed, payroll to the staff, taxes that are owed, painting supplies, bought on credit, a business loan that was taken out to buy the company van, things like that. So I think it's pretty cut and dry, the difference between assets and liabilities. Assets are things that can make you money, liabilities are things that basically cost money. And you can use liabilities in order to build your business. However, you just want to make sure that you have more assets than liabilities. The example I like to use is from Baby Boy with Ving Rhames, where he basically calls it guns and butter. So guns are stocks, bonds, artwork, things that appreciate with value. And then the butter is cars, clothes, jewelry, and other things that lose value as soon as you buy them. So that's really the long and short of what I can really tell you for assets and liabilities, at least for this video. This is just a brief overview. We will be most likely going into more detail in a further video down the line. But thanks everybody for watching. I appreciate everybody for tuning in. If you guys like what you saw here in the video today, make sure to leave a like and a comment down below. The like helps out with the algorithm, and the comment is if you have anything that you want to say about the video, go ahead and say it. Positive or negative, really. I like the constructive criticism. And also, if you have any suggestions for any videos you may want me to make here in the near future, leave that in the comments down below. And if you have not already, hit that subscribe button because I want to go ahead and build up this community of like-minded individuals and then share information amongst us so that we can all make the come up. So thanks everybody once again for watching. I will see you guys in the next one. Peace.